Good evening. I was waiting
Good evening, sir.
for the crowd to join. Still, we have 25.
Good evening, sir.
Right. While others join, let's start. Let me share the screen. Hope you all can see the screen.
Yes, sir, we can.
Right. So let me recall what we started discussing. So I told you when investors put their money in a business, they also take a risk. They need to make sure that they achieve their goals and their money is safe. But they sometimes do not realize their expectations, therefore, they run to a risk. And when you talk about risk, there are various sources from which we can get an idea about the risk. However, we are not going to discuss all of those sources in this course. So we are limiting our discussion to what we can identify from financial statements. So the idea here is how we identify the risk through analyzing the financial statements. Sometimes we can see the risk on the face of the financial statement based on some information, the way it is presented, the numbers. Say, for example, if you look at the P&L, if it is a loss, there is an indication of risk. But there are certain types of risks that are not very visible. You can't see on the face of the financial statements. You may have to dig a little bit and maybe need to do some analysis to find those risks. And then we discussed what are the different types of risks we can identify using financial statement. Financial flexibility, short-term liquidity, long-term solvency, credit risk, bankruptcy, market equity risk, and financial reporting manipulation risk. These are the risks that we are going to discuss under this topic. And then I, in fact, discussed some of these risks. I've discussed about financial flexibility, and we pay attention to the cash flow aspects earlier before we start talking about it. So the financial flexibility part, we discussed how the financial leverage can impact the shareholders. And there we also discussed the decomposition of ROCE and how we isolate it. And I told you not to worry too much about these formulas because at the exam level, you don't need to worry about them. You won't get calculation as such. But this is a technical explanation as to how the disaggregation of ROCE can give us some insights. Then we discussed short-term liquidity risk. In short, whether the firm is able to meet the routine operational commitments. Can you manage the day-to-day cash? Can you serve the debts? And that's what we discussed under this. And then it can be due to either untimed cash inflows and outflows or high degree of long-term leverage. Because timing matters then long-term leverage. Because the long-term debts are high, it can impact your short-term liquidity, because any long-term debt, there is a short-term component. Now, if you look at the previous one, the untimed cash inflows outflows, I'm not sure whether I have clarified that the previous day. So the untimed cash inflow outflow story, I sometimes discuss with an example from non-asset liability. Let's see. As the balance sheet debt, you can say you have assets, you have liabilities. You have asset 200, liabilities 100. So by the look of it, we are in a comfortable position because we have more assets. Now, these assets, you can have cash, debtors, inventory, and various other things. Liabilities also, creditors, payable, different kinds of liabilities. Let's say you have cash 10 and debtors 150, inventory 50, something like that. And then if your first realization of 150 comes in 3 months' time in March, right? You get 50. Inventory, it takes 1 month to realize. Let's say you are in January, maybe in February, you realize 30. Now cash, you have 10. So if you look at March, right, then you have February, you have January here. So January, and until you get this realization here, and until the end of January, your cash component is only 10. The next 30 comes in February. Imagine you have a trade payable of 20 in January. What happens? Although your overall assets are more than the liabilities, by the end of January, you have a problem because you have cash 10, but you have a commitment of 20. So that creates issues. This is an example of a timing issue, right? You can have cash inflows and cash outflows, but if the timing doesn't match, if your inflow doesn't come in time to support the outflow, you can run into problems, right? That is the idea behind untimed cash inflows and out. So we have discussed the other part the other day. Then we also discussed the ratios, right? Current ratio, what it indicates, and the quick ratio. And I also asked the question why we take the inventory out, and we discussed in detail the reason behind it. Right. So this is where we stopped the other day. This is where we stopped the other day. Any questions you have before I start the next slide from today onwards? That's what we have to discuss. This is where we stopped the other day. Any questions or clarifications? Why? If you do not have any questions, let us move. Right. So we generally look at current liabilities and current assets when we talk about liquidity or short-term situation. And we also look at, as you can see here, operating cash flow to current liabilities. Earlier, we looked at the current assets you find in the balance sheet against current liabilities. Now, as I told you earlier, even within current assets, you have different types of assets, and there's no guarantee that the entire thing you find inside the current asset will get converted into cash within a given period. Therefore, apart from comparing the current assets versus current liabilities, it may be a good idea to look at from the cash flow point of view. That is what you can see here. You compare the operating cash flow to current liabilities. You match the cash flow, operating cash flow with the current liabilities and see from a cash perspective, do we have sufficient cash being generated to support the liabilities? Then we have other working capital activity ratio. Now, this includes accounts receivable turnover, inventory turnover, accounts payable turnover. That means for a given time period, how many times you get these things moved. So how many times your debtors get converted into cash? How many times your inventory get converted into cash? So that's the idea behind this. So there are different formula you can use to calculate these things, but this indicates that. Now, these are the indicators to explain you the efficiency and effectiveness of those areas, right? More than the number, because it's a turnover ratio. Therefore, it suggests the degree of efficiency, right? Then we can also compare revenue to cash. So what can we get by comparing revenue to cash? That gives you an idea from your sale, because sale is not cash, right? You can sell. From your sale, how much is actually getting converted into cash? So that gives you an efficiency figure again in terms of your collection. So it says reflect the net effect of operating, investing, financing activities on cash and management judgment about the desired level of cash. Lenders prefer a smaller revenue to cash ratio and large number of days revenue available as cash on hand. What does it mean? Right? Smaller revenue to cash ratio. Right? And large number of days available as cash on hand. So if you have this ratio high, that means you have more cash. Right? Days revenue held in cash, number of days sales the firm has on hand as available cash. So that is these ratios sometimes, while giving indicators about the risk, because if the ratios are on a negative side, it gives an indicator. They are also used to forecast the financial. What do you mean by forecast financial statement? When you do this, you identify the patterns. Right? This is how it works. So that will help you to identify the pattern to forecast. Okay? The pattern to forecast. That helps you to predict the future. Because when you do forecast, this is an important aspect. Then we talk about long term. So we discussed the short term up to now, right? How we handle the short term finances and first short term cash management. Then when we have long-term solvency risk. Long-term solvency is, in very simple terms, is about whether the organization can obey or can meet the long-term requirements. So you can settle the long-term debts on time. So if you have the ability to do so, you are on a safe zone. Now, when you do this long-term financing stuff, if your overall mechanism is not efficient, you cannot get the benefit out of it. Right? So this includes some debt ratios, interest coverage ratio. What do you mean by interest coverage? So debt ratio is total debt against assets. We are discussing it in detail later. Interest coverage, whether you have adequate profits to cover the interest. Right? Then you see from a total liability perspective, your total operating cash flow. So how far your operating cash flow is supporting the liability. So if the ratio is high, that means you are under control. So these things will eventually link up with the liquidity and the long-term financing options. So that's something that we need to keep in mind when we look at this long-term solvency risk. Because when you say risk, more than you talk about the overall organization upfront, when your debt is going up, it brings more risk to the equity holders because their claim goes further down. And it also has a risk of losing the business. So the more debt, the business can collapse at point. So that will also affect your equity holders, because equity holders are worried when the debts are increasing. Right. So you can raise your questions, clarifications if you have as I move on. Right. So otherwise, I think you are comfortable with it. Right. So then we go further into each of these areas. You say debt ratios. I told you, you are looking at your debt in your capital structure. Now here, I must emphasize, in certain books, when you just say debt ratio, in certain books it says it captures all types of risk. Right? All types of. So for example, when you say debt includes short-term and long-term. So then it captures the entire pool together. But in this case, the definition in the relevant note says debt ratio we only consider long-term. Right? So it depends, but here you have to go by what is there now. So what does it mean? If the ratio is high, what does it mean? What does it mean? That means if the ratio is high, you indicate a higher level of debt exposure. So when the debt exposure is high, that can create a risk. Then, if you go back to that decomposition part, which I didn't want to discuss in detail, this is an alternative computation of leverage used in the ROCE. So don't worry about this part because that's linked to the previous thing. But my main thing I want to highlight here is that the debt we are talking about here is the third party commitment. So we have an obligation to a third party apart from the shareholders. And that component, when it becomes higher, it increases the risk as well. Right. Then this slide talks about commonly used measures of debt ratios. Right. Commonly used measures. So liabilities to asset. Liabilities to asset. Total liabilities, total asset. So the asset base of an organization is funded. Asset base of an organization is funded primarily through channels. One is debt, one is equity. Now this ratio we are looking at out of the total asset, what proportion is funded by the liabilities, right? What's the portion of your assets are covered by the liabilities? So you can see this entire formula is in the same line, expanding it. Right. Now, then after considering the liabilities as a pool, we can also look at long term, because we talk about solvency. So therefore, the long term is a must. So in the previous case, we got long term including long term, we have those considerations. Now we have long term only. So then here it says how it is compared with the shareholders' equity, right? Long term debt, shareholders' equity. So in some cases, we call this debt equity ratio, right? Debt equity ratio. That is also there. And then we have interest coverage ratio, I told you. So how do you calculate this? You take the interest payable, right? The interest component of loan. And then you see the profits that the company is generating. And when you divide the profit by the interest, that gives you a feeling about the cushion available. That means whether the profit figure is higher, right, than the interest. So that this can't be, let's say, for example, if your profit can be 100 and your interest component can be 95. So very thin margin, right? If you have, and if profit can be 100, your interest can be 25. That means 4 times, right? So your profit is 4 times the interest commitment. That's a very important ratio, because this gives you the ability for organizations, right? The ability for organization to accommodate interest considering the profit. Because if the profit has a larger cushion than the interest, that gives you a protection. But if the profit is lower, your number, let's say, as I told you, right? If the profit is 100 and the interest is 95, it's a very low. If the profit is 100 and the interest is 50, that means your profit is 2 times your interest cost. So that's a better position than the previous one. This is what we're trying to say. So the reason why we need to look at this ratio, power ratio, is among other things, to ensure that you have sufficient debt capacity, sufficient cushion in that, right? Because sometimes organizations keep on expanding their loan book, right? So maybe they keep on borrowing, and then they don't realize at a point your interest is greater than what you can afford, because your loan capacity should not be looked, that should not be evaluated purely based on your balance sheet strength. Right? From the balance sheet, you might say, okay, I have an asset of 100 million owned by me, right? The company. So the company has it. So this 100 million is there for you to borrow when you have a cushion. But you have only borrowed 10 million. That means you have another 90 million remaining in the balance sheet. So then you can, okay, I can go to a bank and obtain a loan. But the problem is, although you have the capacity in your balance sheet to go for more loans, if your P&L is not strong enough to absorb your interest cost of that loan, you have a problem. Right? I have seen in many small businesses, right? Maybe that is true for large organizations as well. They just borrow based on your balance sheet comfort, but not looking at the P&L to see whether the P&L can digest it, absorb it. So this kind of indicators helps in that, because in the interest cover ratio, I'll tell you what is the gap between your interest and the profit. So how many times of your interest is profit. So the higher the ratio, better it is. That means you have a greater cushion. Then the same thing in a different level, operating cash flow to total liabilities. Right? So you look at the cash flow against liabilities. Now this will also help the reader to understand how the organization is settled into this, whether the organization has adequate capital or cash.
Professor, I got one question.
Yeah.
Now we are calculating the interest coverage ratio according to the EBIT. So when it comes to like if the company is having a certain amount of debts, and the other side, if they have the like the what we call the deposits kind of investment income. So which means that when it calculate to EBIT, so it doesn't calculate along with the interest income. So therefore that then when that calculation gives the other way around. No? So when it comes to net profit, the company is generating well enough money to cover that interest. Is that?
Yeah, you're right. So you brought a very good point, right? If it is from the same company, that's a different story, right? So it's practically it is not. It may not be the case, because you can't have borrowing and lending from the same company. Maybe you have lent to one company, you are borrowing from another company. So that's the practical scenario.
Yes.
Yeah. So in that case, you need to look at this. Okay, let me take an example. You got a very valid point here, right? Let's say your profit is 100, your interest income is 50, right? Your interest expense is 75, right? So in this scenario, your profit with interest income is 150, your interest expense is 75, so the cover is 2. But in this model, there is a 50 as interest income. Your operating profit is this 100, right? So operating profit versus interest cost, that is not 2, right? It's 1.5, little even less than 1.5. Your coverage is lower. The cushion is only 25. Now, the idea behind this ratio is to look at how sustainable is your profit to meet your interest cost. Now, this kind of a scenarios, you have to look at this little more practically. For example, if you have this 75 interest cost, let's say you are your loan, you have to serve for 5 years, and you are getting this interest income from the other company, will you get this interest income over the next 5 years, or is it a temporary situation? If it's a temporary situation, the safest way to calculate the ratio is taking this out, because then this income is just a temporary scenario. It doesn't give you the real picture of your real earnings capacity. So that's why in most of the cases, what we say is, when you calculate these ratios, don't consider one-off cases, ad hoc cases. And in this business, 100 is your core business. That is the operating profit. This other 50 is an interest income. But if your business has a continuous stream of income, so this, let's say this is your group treasury sometime, right? Most of the large conglomerates have a group treasury or the head office. Then as a practice, you keep on lending to your group company. So therefore, this interest income is a kind of a given, it's a kind of a continuing thing. If that's the case, considering both for the ratio is not a harm. Otherwise, you should only look at this, what is sustainable, get the sustainable income and then match it with the cost and see the gap. I hope you got my idea, right? So the idea is to look at the operating profit versus.
Yes, sir, same situation, because my company, we are kind of a group of companies, and the partner company, they used to take the loan from the banks and funding for other companies. So in that case, we charge other companies the interest, we charge them the interest. There is an interest income. In that case, we can nullify the interest income and the interest expense, and there is no involvement of what we call this the interest coverage ratio, because one side we are getting and other side we are paying for that.
Yeah, if it's a continuous stream, it's another this thing, because you need to understand the business model there. Right?
Yes.
It's a business model. So these are all ultimately why we do this. This is to support decisions. Right? So you need to look at how you want to present the numbers and analyze to support the decision. If you are talking about the organization's overall performance, there can be setting of situations. You are getting from here, giving to another. So this is a kind of from a group perspective, there is no impact. But because you are managing the treasury function, for certain companies, it's an income. For certain companies, it's an expense. Because the central point is managing it. You take from one, give to other. Right? So it's like a bank. Treasury is something like a bank. Right? You are an intermediary there.
Clear, sir. Thank you very much.
Okay. Good question, anyway. Right. So then earlier, the first part is about the profit versus interest cost. The second part is about operating cash flow versus liabilities. And operating cash flow to total liability. Whether your cash flow is sufficient to. So the idea here is not to see whether you are generating cash flow to meet all your liabilities. No, that is not the case. That is practically not possible also. Right? The idea is whether you have a sufficient cash flow generation in the business to serve your debts. Right? So it has to be a reasonable proportion. That proportion may be different depending on the organization situation. So there is a question in the chat box. Someone is asking interest cover ratio is a good measurement for banks or finance companies. Now, generally, for banks and finance companies, that's a different story because these banks and finance companies, your main business is this. So, in a banking institution, your interest related things come on top. Your net interest income (NII) is your gross profit, right? It's a gross profit calculation. It doesn't come at the lower level. In a manufacturing company or service company, you have the operating profit and then comes the interest cost. To understand the difference, fundamental difference, right? So in the banking setup, it's a different. So for finance companies, we don't calculate the traditional ratios that we have for other manufacturing or service organizations. We have a unique set of ratios when it comes to financial institutions. The net interest income (NII) or NIM, net interest margin, is something that we use that is somewhat equivalent to gross profit in a normal company, right? For the whoever asked that question, right? Let's go. Then we have the credit risk. So it's easy to look at this credit risk from a bank's point of view. So finance companies, when they lend money to businesses, they follow this technique, and this goes well with other organizations as well. So when you give a credit, there's no harm in going through these parameters. But the thing is, for a normal business or a manufacturing company or a service business, it may be too much if you follow the criteria that a financial institution uses when they lend money to customers. When you sell goods on credit to customers in a manufacturing company or a sales or trading company. So generally, we don't see that level of stringent approach. But as you can see, this is an important area because we are talking about risk. So risk means there is an exposure at the end. So credit risk is the chance or the probability that the lender will not be able to recover the money. So in a lending perspective, from a bank's perspective, when you lend, you also need to collect interest. So your inability to collect both the interest and capital is coming under credit risk from a banking setup. Now, when you lend, there are things that you look at, right, to establish your the borrower's eligibility to obtain the funds or to get the credit. So this is called C's, 6 C's. Sometimes we have 7 C's. Sometimes you have 8 C's. So depending on the number of C's you use in evaluation. So now one of the things is circumstances leading to a need for loan. Why do you need a loan? So that's an important thing. So why you need credit? Say for example, let's say you are a business and you go to a bank asking for funds. And when the bank asks why, if you say, I need working capital because I need to purchase goods to resell. So I need some money to purchase more goods. So there you give money for the business to buy goods and sell. After they sell, they generate cash and then it will help them to repay. So that's a positive thing for a bank. But if the business says, I need money to pay the salaries of my staff, that's a different thing. That is for consumption, that is for expenditure, not to generate revenue. Therefore, the risk is higher in the second instance, right? The reason. Then the credit history, like the track record of the business. Whether the customer or the business has a history of repaying, right? history of repaying the loans on time, or whether there are issues in the past. That's something that you need to look at. So that gives a idea. So if they have a bad track record, that indicates a higher risk. If the track record is good, the risk is low. But don't get this wrong. Just because you have been good in the past doesn't mean everything will go well in future as well. Because this is a trick. Even these pyramid structures, all these scammers use, right? You put money, they are very good in the initial stages. You feel good, okay, when they pay on time, you feel comfortable. So then you put more money, right? Then all of a sudden they stop. Then you lose whatever you invest. So therefore, just because you have a history doesn't mean that everything will be okay in the future. But the idea here is that from a debtor point of view, borrower point of view, the fact that the person has honored the previous commitments gives you a positive score when you assess the credit risk. Then you look at cash flow, right? Cash flow, whether the organization generates sufficient cash flows to prepay the loan. That's where the bank especially demands a cash flow forecast from the business when they ask for a facility, so that they can ascertain whether the cash flows they are generating in future are sufficient to meet the organization's need and then pay the loan. Collateral, I think we all know what collateral is. That is the security or the support or the backup that we provide to the bank when we obtain a loan. And that can be applied in an organizational context as well. Sometimes when you give credit limits, you keep a bank guarantee, right? If you are giving a large stock to a dealer or something, there is a practice in most of the distributors. They keep a bank guarantee. So bank guarantee is your collateral. So based on the bank guarantee, you give the credit facility for the organization. Then capacity for debt. That's very important. Capacity for debt. I explained earlier, sometimes the organizations demand facilities, but whether they have adequate capacity to accommodate. So capacity is looked at from two perspectives, right? The first one is whether the organization has sufficient balance sheet space to accommodate more debt. That means whether you have assets to support the loan, and also whether you have sufficient size of a balance sheet to accommodate more debt. If you're already exhausted, you can't. But the other thing is whether the organization is generating sufficient cash, and then you calculate backward. That's in other words, let's say you look at your cash flows. So let's say you generate, in the current context, your excess cash is 5 million, which means the maximum loan installment you can now accommodate is 5 million. So whenever you go for a loan facility, your installment should not be more than 5 million. So you backward calculate and see, for me to service a debt with a 5 million regular payment, what is the maximum loan I can borrow from the bank? That is your capacity for that. Right? You have to look at that. But sometimes organizations don't do that. Even recently, an organization came to me. They are kind of stuck with the cash flows. The organization is highly stressed, and they have a bank facility and they are now going to negotiate with the bank for a settlement and restructure. And they have, the finance guy of the company has done a calculation and sent it to me for my validation. They say we have some fixed deposits, we have some loans, so we are planning to liquidate some of the fixed deposits and we are going to restructure the loan, and we are going to ask from the bank for us to give a facility of this size with a grace period, and then we will have a installment going forward at this level. My first question for them was, before you do all these calculations, did you assess your capacity? When you go to the bank, you need to tell the bank what is the maximum you can afford, right? What is the maximum installment? What is the maximum cash you can generate to service the debt? And whatever the arrangement you are going to have with the bank, you need to have that negotiation within that limit. So if you go and discuss with the bank for a 10 million installment, whereas you can only generate 5 million, your restructuring won't work. So this is a mistake that most of the organizations do, right? Therefore, it's very important to look at this. So lender must make that assessment. Right? This also includes the interest cover ratio we discussed earlier, because interest cover ratio will tell you whether your P&L can accommodate that cost. Right? If your debt has a certain amount of interest, that cost should be within the limits of your P&L, right? Whether your P&L can absorb, whether you generate sufficient profits over and above that interest. So those will tell you what the capacity you can go. Then comes contingencies. What is contingency? That means there can be unplanned, unforeseen situations. Things can change, right? Things can change. So if there are certain negative shocks to the organizations, consequences to the organization, whether the organization can still serve the debt, whether we kept a provision in our profits and cash flows to accommodate those shocks. It can happen. Say, for example, if the organization currently has some kind of a lawsuit, right? You have a pending legal case. You need to assess the possibility of losing the case and the resultant commitment from your side in case. Then you have to have cash commitments, then it might disturb your cash flow, right? And you have various other arrangements, right? Whether you have commitments to other parties, whether you have issued guarantees, right? If your guarantee materializes, you have to pay. And also, if you are dependent on some, let's say the organization is dependent on one supplier or one customer, right? So these kind of scenarios, or maybe a critical employee who's technically sound to run the show. In case that employee leaves, in case that single supplier disconnects with you, in case that single customer is lost, you have a shock on your numbers. So are we still comfortable to continue or serve the debt with the shocks? So that kind of analysis the organizations do. Therefore, this contingency thing is about having a cushion, having some kind of a extra cash flow or a provision to accommodate those shocks. Character. I don't need to explain this. Character is important here because earlier we discussed about the organization's track record, whether they have been good in the past in serving the debts and all. Now you also look at the credibility and competence of the management. Credibility and competence both, because credibility is trustworthiness. Let's say the management, there can be changes to the management. The chief executive officer has left the organization and they have hired a new CEO. And this new CEO is a well-known crook, right? He has led another few companies bankrupt, and now this guy is here in this organization. So that is a matter of concern for the lender, right? This guy can ruin the company here as well. That's very important to look at the character of the management in that sense. Right. Then the communication. What is that? That is also important, especially the financiers looking at. That means the lender expect proactive communication between the lender and the borrower throughout their relationship. Because sometimes what happens is when the borrower takes the money and vanishes, there's no communication between the two. You have no way of figuring out what's going on with the borrower. What is happening, right? What are the latest updates? Any significant matters at that time that might help you reassess the credit risk of this party, right? So sometimes these communications might be important because one of the key employees in the organization who is contributing heavily to the production has passed away. So that's a piece of information for the banker, because the banker then realizes that this can have an impact on the organization's performance and eventually the cash flows. Therefore, it's very important that the two parties maintain this regular communication. That's why, especially in the banking setup, at a certain point, they have this position called relationship manager. Relationship manager is there to maintain the link between the bank and the customer, and that party is expected to have complete knowledge about the customer and be on the ball. And if there are any issues, that this party needs to know before it hits the organization, because the party is in touch with the customer. Therefore, this communication is so important in maintaining that. Then we have conditions and covenants. Give me a second, I am getting a call. Give me a second. Right, sorry. Then conditions or covenants. So that means when the banks lend, when they have doubt about the party, what the bank is doing is they put conditions or they put covenants. What are those? They give a list of things that you need to comply when you want to continue this. Say, for example, they say, you are not supposed to declare dividend, right? You are not supposed to declare dividend without completely paying this debt. Or the organization cannot go for new debt, right? Organization cannot go for new debt without the prior permission of this bank. Right? So that kind of conditions. Or sometimes they say you have to maintain a debt equity ratio at this level, especially when you give a loan for a project or a capital expansion project. So the bank say, okay, if the borrower demands for funds, the bank say, okay, you need 100 million for the project. We give 80, you put 20. So 1:5. And then if you want more, let's maintain the ratio, right? If you need another 100 million, we give 80, you put another 20, so that the debt equity ratio remains. So that kind of conditions. So some of these covenants can be financial or some ratios. Some of these covenants can be qualitative. For example, sometimes the bank might say, you are not supposed to onboard any new director to the organization without informing us. So likewise, there can be different kinds of covenants, right? So this is a very good list to follow but doesn't mean that a typical organization need to follow this like a bank, right? Any questions up to this point? Any further comments or questions? Right, good. Let's go to the next topic. Next topic is analyzing bankruptcy risk. Now, this is a little broader concept, right? Bankruptcy is beyond mere shocks in certain areas of a company. So sometimes you can be running at a loss. Sometimes you can have a lot of debts. So in isolation, when the P&L shows a loss, it's a problem. There's a risk. When your current liabilities are greater than current asset, then it's a problem. It's a risk. But likewise, you can have different negative indicators. But doesn't mean just because you have those negative indicators, you have a bankruptcy issue. Bankruptcy is at a different level, right? Organization having risk is one. Bankruptcy is you are about to die. The company is going to be finished. So the problem or the issue here is that the lenders or the stakeholders need to know the probability or the fact that the organization may bankrupt in future or not in advance. They don't need to know the company is going bankrupt when everything is clear. When the ship is sinking, when you know that it's going to sink, is not what the stakeholder wants. Stakeholder wants when the ship is sailing on the sea, whether there is a possibility for the ship to sink. You need early warning. So for that, there are certain models that predicts the possible bankruptcies, right? Whether the organization will. It's something like, this sometimes when you go to doctors, while after they evaluate the medical situations of patients, there are certain doctors who say, okay, you have a cancer or this kind of an illness, you are going to die in 6 months' time, right? So the maximum life of you is 2 years. So after 2 years, this person is going to die. So how you predict that, right? So there can be certain indicators that will give you that comfort, and that is what we need to look at. So there are different models. These are somewhat complicated models because these are developed based on a lot of research and findings and validations, iterations, because sometimes just because you take 100 companies and come to a conclusion because these 100 companies have gone bankrupt because of ABC things, any company will go bankrupt because of ABC things. You can't sometimes come to that generalization. As a result, there is an error margin as well. So therefore, there are many models. We don't have one single model. There are many models with various variables and considerations to give some input to the management to predict the bankruptcy. Right. So one way of looking at is by looking at financial ratios and indicators, and see by looking at the connections, interconnections among those ratios and other indicators, you can see the way these numbers behave, the company is going to bankrupt, right? So you have univariate, multivariate, different kinds of models. I'm not going to discuss all of them. Now, I'm not going to even calculate these ratios and say, I'm just giving you the idea. There are different models in predicting bankruptcy, right? There's something called multiple discriminant analysis, MDA. As you know, the set score. Set score is the bell curve. We are using the bell curve. You have set score calculations. Then based on the probabilities. For the exam purpose, you don't need to worry, right? You don't need to worry because we are not going to calculate anything in this space, right? Now, this is what is important, right? More than the calculations and ratios, what is important is identifying the nature of them, right? What factors have gone into those assessors, researchers, etc. So you look at the liquidity and asset turnover. These are some of the key components these bankruptcy prediction models use. Because liquidity is a fundamental thing, as we know, I discussed earlier as well. Liquidity is the lifeblood of an organization. If your liquidity is at a stake, there's a higher chance of going bankrupt because of the liquidity pattern. Right. Right. Then there are other factors, financing factors. If you can recall, I think we have finance people here. Some have followed chartered, right? Some have followed various other things. Even when we talk about the audits of financial statements, there is a standard for going concern. Right? Going concern is one of the key elements that we look at when we evaluate financial statements of a company. So it's a basic requirement for any auditor to assess the going concern of an organization. And then you can recall in the going concern assessment, we have these financial factors, operating factors, and other. So somewhat similar considerations are here, right? But for example, what are financing factors? If your debt is excessively higher than what is reasonable, that's a financial factor, right? Then your short-term debt, you have a large proportion of short-term debt that your working capital generation is not adequate to meet that. It's a problem. And operative factors, relative level of profitability means there are standards or norms that certain industries need to maintain if you are to make profitable and to have reasonable profit in that sector. For example, if you are a hotel, they say, the experts might say, in the hotel sector, your typical profitability figure should be 15%. Your net profit should be 15% or something. And if you are running a hotel, your profit is 8%. You can't be complacent with that 8% profit because you are not within the expected level, which means there is a possibility that you have something wrong in your business model. You will eventually get into a problem. Something like that. Then the variability of operations. If your operation is fluctuating unusually, that means you are highly vulnerable to various factors. That is an indicator. Then other, right, the size, growth, because you can say over trading. Sometimes we have over trading situation because the organization is doing the activities. Right. Sorry, there was a connection issue from my side. I think back. Right. So I was talking about the other possible variables. So if you are trading beyond your limits, that's why this kind of parameters are there in the banking sector and insurance sector, because you have something called capital adequacy. Then you have those kind of ratios that pegs your base to the operating level. So if the bank is operating at a particular level, if you expand your loan book, you have to have a proportionate capital base. The moment you increase that capital, the loan book beyond that limit, then the central bank demands you to increase your capital base to support that loan books. Likewise, you have proportionate thing. But in a typical business organization, you don't have that kind of a thing. So sometimes you keep on expanding your sales or other activities, and when you get a shock, you collapse because you have gone beyond what is reasonable for the organization. That happens. Then sometimes the audit opinions gives, and because auditor has gone through the financials and other things in detail, and they are coming up with a qualification that might give a hint about the possible bankruptcy of the organization, depending on the nature and the severity of that qualification. Right. Let's move. Then we have market equity beta. So what is equity beta? We know equity beta, right? Yeah, we are coming back to this even later. Equity beta. So beta is something that we use even when we use the cost of capital CAPM model, we use it. Beta represent, right? Beta represent the variability of a security or a firm's return relative to the market return. Say, for example, if the market return fluctuation is 5% and you have the firm's return fluctuation, that can be derived through beta. Let's say if your beta is 2, you get firm's risk you get the firm's risk. You can derive the firm's risk based on the market. Market risk 5%, beta 2, then the firm's risk is 5% into 2. That is 10. Right? That's how you get it. There is a formula to get at. But the idea is the beta explains or supports to derive the firm's risk from the market risk. And it says beta is a measure of the systematic risk. What is systematic risk? There are 2 types of risk: systematic risk and unsystematic risk. What is systematic? Can anyone tell me? Systematic risk. What is the idea? Systematic risk? Systematic risk refers to a risk that is not possible to diversify, that is not possible to eliminate. You know, when we talk about the portfolio, we are creating a portfolio to diversify risk. Why? We have I have a problem of losing, let's say, I am into ice cream selling business, right? But the ice cream sales can come down during rainy time. Then I have a risk because my revenue is at a risk, because ice cream business has a risk during rainy time. Then I can start an umbrella business. So I diversify my portfolio. On not only doing ice cream, I go to umbrella. So during rainy time, I can sell umbrellas. So my ice cream business will go down, umbrella business will go up. So by having both, I am stabilizing my revenue. During rainy time, I sell umbrella. During sunny time, I sell ice cream, so that the risk, that is a variability, I reduce. So that is a unsystematic risk, because I can diversify that risk by having another portfolio, getting into another business. But there can be certain other risks. You can't eliminate that by diversifying. Now, currently we have a risk in Sri Lanka. We have a risk, country risk. We have our economic crisis. Now, just by shifting to ice cream business from umbrella, I can't reduce that risk. That risk will anyway be there. If there's a political risk, that political risk is there right across. That is called systematic risk. Systematic risk means the risk is common to all scenarios. Therefore, by creating a portfolio, you can't diversify or you can't reduce it. Right? Political risk, economic crisis, terror risk, right? Some weather-related things. Let's say we had a pandemic, right? Pandemic is a systematic risk because the impact of pandemic is across the board, irrespective of the business you have, right? Right, so equity beta risk, degree of operating leverage, degree of financial leverage, variability of free sales. So these are the high level things that will affect the organizations. Operating leverage is how far you are dependent on the fixed cost, because if your fixed cost is high, a slight variation in your revenue can have a big impact on your bottom line. Financial leverage is the level to which your organization is exposed to debt capital, right? Loans. Sales fluctuation is the other one. Then we come to the last part of this presentation. That is called financial reporting manipulation risk. We talk about different risks earlier, right? We talk about different risks. In those risk factors, we identify different aspects of the financial statement and the risk. And the last item was the reporting manipulation risk. Here the problem is, all this time we discussed about the risk that is embedded in the information provided in the financial statement, right? Whatever the information provided in the financial statement gives you the risk factors. Now, this particular risk is about the integrity of what is there, integrity of financial statement. What if the information provided in the financial statements are wrong, misleading? Because all the previous risk factors we considered on the basis that whatever you see in the financial statements is true, right? But if it is wrong, then you are depending on wrong information and coming to wrong conclusions. This is called fraudulent reporting. Earnings manipulation is a fraudulent reporting. The present of financial statement can manipulate, right? There are various ways of manipulation. Why people manipulate? Number one, right? Number one, we need to see why people manipulate the financial statements. Because you can push your stock prices, right? If the real information goes to the market, it can affect your stock prices. Therefore, people sometimes sends wrong information, misleading information, so that the market will not get the shock. They will believe in it and then will not upset the market price. Then another reason is why management do it, because they can get a bonus. So if the real information is affecting their KPIs, right? If the minimum profit figure to achieve bonus is 100 million, and if you have achieved only 95 million, you jack up the profit and make it 100 million to earn your bonus. Right? And then by giving a positive image about the organization's credibility goes up. When the credibility goes up, the risk goes down. When the risk goes down, you can borrow at lower rate. Your cost of finance comes below. So to get that advantage, people manipulate things. And then to avoid violation of covenants, I told you the technical defaults, you have to maintain debt equity ratio, you have to maintain, prefer certain, let's say, profitability ratios to maintain your debts, because given by the banks or the providers of funds. You manipulate the numbers to maintain those ratios. Otherwise, you get a problem from those suppliers of funds. Then to impact corporate control transactions. So when you say corporate control transaction, it can go either way. Say, for example, if there is a possible takeover threat for the organization, the management can artificially manipulate the numbers and jack up the share prices. And then the deal becomes expensive for the investor. Right? Or other way around, you can showcase the company is not doing well, if the company is a failure, the company is not profitable, no point in investing in this company. So you can show that picture as well to discourage possible investor to come and take this company, because the investor doesn't see a potential of this company. Then avoid regulatory, right? There can be regulatory consequences or penalties. To avoid that, you manipulate the number. So what are the cases we find? That there are certain models. Here, what they are looking at is these researchers, they identify certain factors that indicates possible manipulations of financial statements. Right? When you look at these things, you can see, okay, here there is a possible manipulation here. The company is not telling the truth. So these are the models. These models, when you apply, there are 12-factor model, 18-factor model. Likewise, you have things. So when you apply these models, you can get an idea whether the organization has manipulated or not, because it doesn't make sense. Say, for example, I'll tell you a very basic thing to understand what these models do. Right? Let's say you say this company sells 12 units of product during the period. That's what you say. So your inventory says you have got 30 items, sold 12 units, so remaining is 18 in the inventory. If you go to the sales figure is 500. Now, if you look at the numbers, right, the average price of a unit is 10. Average price of a unit is 10, so 12 into 10 is 120. So when you reconcile the inventory with average price versus the actual sales, you can see technically it should be 120, but the sales figure says 500. That means there's a manipulation here. One of the two is wrong. Right? I mean, that's a very basic, simple example I gave you. Likewise, these models, what they're trying to do is they try to identify different parameters in the financial statements and combine them and do some processing and say, look here, there's something wrong somewhere. Or there's manipulation here. Or maybe they can pinpoint and say this particular area is wrong. So that is a good thing. You can surface or uncover the manipulation. Right. So we discussed a few aspects in this presentation. We discussed the importance of identifying the risk factors, how to figure out the risk, and what are the different models. And we discussed also the bankruptcy models, and finally financial statement manipulation risk and how we uncover it. That's the end of the first lesson. Any questions, clarifications? Any questions, clarifications? Okay, if you don't have questions, that means all good. But I suggest is, because we have completed this lesson, let us take a break now and then go for the new chapter. We'll get back in about 20 minutes time. Yeah.
Yes, sir. That's good.